Imagine looking at your totally safe, completely boring savings account and realizing you could safely bump your interest rate up by a full 25% tomorrow.
I mean, everyone would take that deal. It sounds incredible.
Right. It sounds like an absolute no-brainer for you, the listener.
Yeah.
But what if the catch was that your so-called safe cash secretly had a trapdoor tied directly to the stock market?
Well, that right there is the ultimate behavioral finance trap. We all have this inherent psychological itch to make our money work harder, even the money that is specifically supposed to just rest.
Yeah, exactly.
When rates are low, people chase yield into really dangerous territories. And when rates are high, they still chase yield because they just think they can beat the baseline.
Which brings us to the core tension of today's deep dive. For the longest time, cash was trash. It earned practically nothing.
Literally zero.
But now that cash is finally paying decent yields again, the financial industry has built these completely new, really complex engines to feed that appetite for just a little bit more juice.
They absolutely have.
So today, we are putting two heavyweights in the ring to see if reaching for that extra yield is actually worth the hidden risks. On one side, we have the heavyweight champion of passive cash parking, the iShares 0-3-month Treasury Bond ETF, ticker SGOV.
The absolute gold standard of boring.
Right. And on the other side, the modern challenger promising extra juice, the NEO's Enhanced Income 1-3-month T-Bill ETF, ticker CSHI. We are going to dissect exactly how CSHI generates its extra yield and whether the risks hiding under the hood are actually worth the reward.
It's a fascinating comparison.
Before we get into it, I just want to quickly mention our source stack for today. We're pulling from the official NEO's fact sheets and their annual reports up to mid-2026, some great risk metrics from Koala Gains, market analysis from ETF trends, and some really sharp breakdown insights from a recent Diamond Nest Egg video.
Lots of good data to sift through. And of course, just a quick reminder before we jump in. This deep dive is strictly for entertainment and educational purposes. We are not your financial advisors, and this is not personalized financial advice.
Perfect. Okay, so before we can compare CSHI to a standard fund like SGOV, we really need to understand the mechanics. Like, what is the actual foundation of this ETF?
Well, the foundation is actually surprisingly traditional. Under normal circumstances, CSHI parks at least 80% of its assets in highly secure 1 to 3 month U.S. Treasury bills.
So just short-term IOUs from the U.S. government?
Exactly. They mature so quickly that they carry almost zero credit risk and virtually no interest rate risk. That is the boring, stable core of the portfolio.
Okay, so the vast majority of the fund is doing the exact same thing that any standard cash equivalent fund does. The real mystery, then, is what they're doing with that other 20%.
Yeah. That remaining slice of the portfolio is the active management component. It's the engine driving the extra yield. The portfolio managers use that capital to actively execute an S&P 500 index put option spread.
Okay, wait, let's translate that out of Wall Street jargon. S&P 500 index put option spread sounds incredibly dense.
It does sound like a mouthful.
If I'm visualizing this, is CSHI basically acting as a boutique insurance provider for nervous stock market investors?
That is actually the most accurate way to frame it, yeah.
Yeah?
They're quite literally selling insurance policies against the stock market drop.
Oh, wow. Okay.
They go to equity investors who are just terrified of a sudden pullback and offer to cover their losses if the S&P 500 dips slightly over the next month. And in exchange for making that promise, CSHI collects very expensive insurance premiums up front.
Right, and if the market stays flat or goes up, CSHI just pockets that premium as pure profit, which then enhances the monthly yield they pay out to you.
Spot on.
But wait, selling naked insurance on the S&P 500 sounds like a recipe for getting completely wiped out in a market crash. I mean, if the market takes a 20% nosedive, aren't they suddenly on the hook for massive payouts that would just destroy the fund's principal?
They absolutely would be, which is why they don't sell naked insurance. They operate like a highly cautious, very smart insurance company.
Okay, how so?
Well, as soon as they collect that expensive premium from the nervous investors, they turn around and immediately buy a cheaper, sort of catastrophic reinsurance policy for themselves.
Oh, I see.
Yeah, they buy deeper out-of-the-money put options.
So they're basically building a floor. It acts like a built-in deductible to cap their maximum losses if the market completely crashes.
Exactly. Let's use a hypothetical math example to make the mechanics really concrete. Imagine the S&P 500 is currently sitting at 7,000. CSHI might sell a put option promising to cover losses if the market drops below 6,500.
Okay.
And for taking on that risk, they collect $100 in premium.
Right, so they have $100 in their pocket, but they are totally exposed if the market falls through the floor.
Exactly. So to protect themselves, they take $80 of that premium and buy a different option that covers them if the market falls below 6,300.
I got it.
So they have successfully capped their absolute worst-case scenario. If the market stays anywhere above 6,500, both of those options expire worthless. CSHI nets a $20 profit to distribute to their shareholders.
That's fascinating. So they carried the risk for a minor dip like that specific window between 6,500 and 6,300, but completely insulated themselves from a total 2008-style market collapse.
You nailed it. That mechanical loop is what drives the fund.
And it clearly works to generate income, right? I mean, looking at the performance context from our sources, over the past year leading up to April 2026, CSHI actually paid out nearly 5%. Specifically, a 4.97% trailing 12-month cash distribution yield.
Which is huge.
Yeah. Meanwhile, its passive pure treasury competitor, SGOV, only paid out 3.99% over the exact same stretch.
And a full percentage point of extra yield in the fixed income world, I mean, that is a massive gulf. It completely changes the conversation for institutional and retail investors alike.
It really does. It forces you to look at your standard savings and wonder if you're just leaving money on the table by playing it too safe.
Exactly.
But generating a full extra percent of yield using options sounds great on paper. My immediate cynical thought, though, is what is this actively managed team actually costing me? Because trading S&P options every single week isn't free.
No, it definitely is not free.
So we need to look at the raw numbers head to head to see if the cost of running this really complex strategy just eats up all the profits.
Right. Well, we should look at SGOV first to set the baseline.
Okay, let's do it.
So SGOV is an absolute behemoth of a fund. It has roughly $84 billion in assets under management. It is entirely passive. A computer simply buys T-bills, holds them to maturity, and passes the interest directly to you.
Beautifully simple.
Right. And because it requires virtually no human intervention, it charges a minuscule expense ratio of just 0.09%, 9 basis points.
You're practically getting it for free at that point.
You really are. Now, CSHI is a very different beast. It is much smaller, roughly $1.4 billion in assets. And because they have a literal team of portfolio managers actively analyzing volatility and trading those S&P 500 options, it carries a significantly higher expense ratio.
How high are we talking?
Between 0.38 and 0.39%. 39 basis points.
Wait, 39 basis points? That is more than quadruple the cost.
It is a steep jump, yes.
As an investor, doesn't that massive fee drag defeat the entire purpose of trying to squeeze out extra yield? Like, if I'm paying an active management team that much of a premium, aren't they just eating the extra yield they just generated for me?
Right. I mean, you always have to scrutinize the fee drag, especially in cash equivalent funds where the margins are already razor thin. But the net return reality actually surprises a lot of people.
Really?
Yeah. The reported yields and total returns you see on the fact sheets, those are always shown after those management fees have already been completely deducted.
Wait, so the roughly 5% yield we talked about earlier, the fund has already paid its managers before it reports those figures to the public?
Exactly. The fees are totally baked in. Historically, even after paying that much higher expense ratio, CSHI has still come out net ahead for the investor.
Okay, give me the numbers.
Sure. On a one-year trailing total return basis, which, by the way, factors in both the monthly distributions and any fluctuations in the share price, CSHI beat SGOV by roughly 2%. It posted a 6.08% return compared to SGOV's 4.02%.
Wow. Okay, so after the managers take their cut, the investors still walked away with noticeably more money. I can definitely see why the temptation is so strong for people.
It's very compelling on paper.
But the iron rule of finance dictates that higher returns always require taking on higher risk, right? The universe does not just hand out free percentage points, especially in fixed income.
It absolutely does not. There is no free lunch.
Right. Since we know SGOV is practically bulletproof, we have to unmask the risks hiding inside CSHI. It is not a bank account.
No, it's not. And honestly, the biggest risk here is actually psychological. It is the illusion of the cash wrapper.
What do you mean by that?
Well, people buy T-bill ETFs because they want absolute safety. SGOV is a true near-cash equivalent. It has virtually zero credit risk, and the day-to-day bumps in its share price are almost invisible. It is just a flat line.
Right. If you put $10,000 in today, you are highly confident you can pull exactly $10,000 out tomorrow.
Exactly. But CSHI, by selling those S&P 500 put options, explicitly introduces equity market risk into a cash allocation.
They're essentially bridging two entirely different asset classes.
Right. By acting as the insurance company, they are guaranteeing that eventually a hurricane is going to hit. And when the stock market takes a sudden dive, they actually have to pay out those claims.
So if I put my money in SGOV, I know exactly what's there when I go to buy a house or pay a tax bill. But with CSHI, the historical charts from our sources show a very clear seesaw share price pattern.
Yeah, the seesaw is very real.
It does not flatline at all. It actively wiggles based on market volatility and their distribution cycles.
Right, because they are the first loss insurer up to that deductible we outlined earlier. So a sharp, sudden drop in the stock market will eat through their premium income and actively erode the principal value of the fund.
Actually, let me point to a specific event from the research to really ground this emotional reality for you. Do you remember March and April of 2025?
Oh yeah, the tariff announcements.
Exactly. There were those major global tariff announcements that completely rattled the stock market. During that specific window, CSHI suffered a sharp drop of slightly more than 2% from its baseline price.
Which doesn't sound like much.
Right, a 2% drop is nothing for a stock portfolio. You wouldn't even blink. But if you treat this ETF like a bank account and you happen to need to withdraw your cash that exact week to close on a house, taking a 2% haircut on your down payment is a nasty shock.
It fundamentally violates the core premise of a savings account. And to quantify that risk, the analysts at Koala Gains look at a metric called maximum drawdown.
And what did they find?
Well, they actually rate CSHI's overall risk profile as strong because its day-to-day volatility is still very low compared to standard bond funds. But its maximum lifetime drawdown sits around negative 3.4%.
Meaning, at its absolute worst moment so far, it lost 3.4% of its value from peak to trough.
Exactly. Now, it recovers over time because the options reset, and that catastrophic reinsurance cap prevents it from going to zero. But it is definitively not FDIC-insured cash.
You are consciously accepting that mild turbulence in exchange for the extra yield.
Exactly.
Okay, so we've covered the gross returns, we've examined the fee drag, and we've unmasked the equity risk. Now we have to talk about Uncle Sam. Because what you earn on paper doesn't actually matter. All that matters is what you get to keep.
That is the golden rule of investing.
And according to the Diamond Nest Egg breakdown, CSHI is doing some highly engineered maneuvering behind the scenes regarding tax optimization.
The tax design is arguably where CSHI's management team tries the hardest to justify their 39 basis point fee. They utilize two very clever IRS mechanisms.
Okay, let's break them down.
The first involves the options themselves. By law, broad index options, like the S&P 500 puts they use, are classified as Section 1256 contracts.
Section 1256. I've always wondered why the IRS gives broad index options special treatment. Like, why do those contracts exist in the first place?
It actually traces back to historical rules for the commodities and futures markets. The IRS implemented a mark-to-market accounting rule for those specific types of broad contracts. And to balance out the complex reporting requirements, they granted a highly favorable blended tax rate.
How favorable are we talking?
Really favorable. Regardless of how briefly CSHI holds these S&P 500 options, even if they buy and sell them within a few days, the IRS taxes the profits as 60% long-term capital gains and 40% short-term capital gains.
Wow. And long-term capital gains rates are significantly lower than your normal income tax bracket.
Considerably lower, yeah.
So applying that 60-40 blend to short-term trading profits saves you real money compared to a standard active trading fund.
It creates a massive structural tax advantage.
Okay, so what's the second mechanism?
The second mechanism is called return of capital, or ROC. CSHI frequently structures a significant portion of its monthly payouts as ROC. Just to give you an example, in fiscal year 2025, roughly 24% of their total distribution was classified this way.
Okay, let's break down how return of capital actually functions for the listener. It essentially means the fund is handing you a portion of your own money back, right?
Basically, yes.
And the immediate beauty of this is that it is generally tax-free in the year you receive it. You aren't taxed on your own principal. Instead, it just lowers your cost basis in the fund.
Which just kicks the tax can down the road. You defer paying taxes on those distributions until you eventually sell your shares, years down the line. It allows that money to compound in your account in the meantime.
It really is a highly sophisticated institutional-level tax strategy applied to an accessible retail ETF.
It is. But, and this is a huge but.
Here comes the catch.
Yes. There is a massive caveat regarding state taxes. Normal T-bill interest, like the kind you get from a pure fund like SGOV, is legally exempt from state and local taxes.
Which is huge. If you live in a high-tax state like California or New York, avoiding state income tax on your cash yield is a phenomenal benefit.
It is often the primary reason investors choose Treasury funds over high-yield savings accounts in the first place.
Right. But the extra juice that CSHI generates from those option premiums and capital gains does not enjoy that state tax exemption, does it?
No, it does not. They are separate income streams. Depending on where you live, paying state taxes on that option's income could literally wipe out the entire yield advantage CSHI works so hard to build.
Wow. So if you live in California, you might be taking on all that equity risk for literally zero extra net reward.
Exactly, which demands a very serious evaluation of your personal tax bracket before you even consider hitting the buy button.
So who is this actually built for? It's clearly not a one-size-fits-all cash replacement. Let's try to boil this down to a few key traits. If you are listening to this and wondering if CSHI belongs in your portfolio, you need to pass a specific 5-part checklist.
I love a good checklist.
Right. Okay, first box, income focus. You have to be relentlessly focused on maximizing your monthly cash distributions right now, prioritizing that over standard, plain vanilla baseline yields.
Second box is volatility tolerance. You need a realistic stomach for bumps. You have to be completely fine with single-digit fluctuations in your principal. If the fund drops 2% in a bad month, you aren't going to panic and sell at a loss.
Third box, equity risk acceptance. You fundamentally understand that a severe S&P 500 bear market will actively hurt this specific pocket of your safe money. You aren't operating under the delusion that this fund is immune to Wall Street panics.
Fourth is tax design awareness. You really need to know how to utilize the Section 1256 and return of capital features in your broader tax planning, and you have specifically factored in the tax laws of your local state.
And finally, the fifth box, comfort with complexity. You actually prefer the idea of active derivative management over simple, predictable buy-and-hold strategies. You like knowing there is a human team navigating the options market for you.
That is a solid list.
Here is the ultimate rule on this. If you cannot check every single one of those 5 boxes with a confident rule, yes, you are far better off playing it safe with a straightforward, conservative vehicle like SGOV.
I completely agree. The extra percentage point of yield is absolutely not worth the anxiety or, the mismatched tax consequences if it doesn't align with your specific financial architecture.
It perfectly synthesizes the dynamic. SGOV offers absolute peace of mind, extreme liquidity, and beautiful simplicity.
And CSHI offers an innovative options fuel engine for extra yield, but only provided you fully accept the equity risk and the tax complexities attached to it.
It's the cost of doing business when you want to beat the baseline. But before we wrap up today's deep dive, I want to leave you with a final, forward-looking thought to mull over. Something that builds directly on the mechanics of how this fund actually survives.
Okay, let's hear it.
CSHI relies entirely on the stock market, continuously offering attractive, juicy premiums for those put options, right? They absolutely need nervous investors who are willing to overpay for insurance.
Volatility is the literal fuel for their extra yield. Without fear in the market, the premiums just shrink.
So what happens if the stock market enters a period of total sleepy stagnation? Imagine a prolonged environment over several years with incredibly low volatility. Will the premium income dry up entirely?
It's a very real possibility.
If the insurance premiums CSHI collects get too cheap, does this highly active, complex, enhanced ETF essentially just turn back into a standard T-bill fund, except one that continues to charge you an overpriced 39 basis point management fee for the privilege?
Wow. That really highlights the ultimate paradox of the strategy. They need a little bit of fear in the market to make their money, but not so much fear that the market actually crashes and triggers their payouts.
They are perpetually walking a tightrope.
They really are.
And it's a tightrope you should keep a close eye on as the markets evolve. Because at the end of the day, squeezing that extra drop of water from the stone only works if the stone is still wet. Keep questioning your assumptions and keep diving deep. We'll catch you on the next one.